In the unpredictable world of U.S. economic policy, few headlines carry as much weight, or confusion, as Donald Trump's response to Walmart's price hikes. The former president lashed out at America's largest retailer, demanding they eat the tariffs rather than pass the costs on to consumers. But behind this soundbite lies a more serious crisis: a weakening U.S. credit rating, surging retail prices, and a growing fear among investors that Trump's economic strategies could push America deeper into debt and instability. This video unpacks the real-world implications of Trump's tariff strategy, explains the economic backlash, and examines the broader market consequences with clarity and facts, not political theater. Imagine walking into Walmart this month and noticing your weekly grocery bill is suddenly 10% higher. It's not inflation, not a supply shortage, but a direct consequence of U.S. tariffs. These aren't just political weapons in trade wars, they are taxes. And despite what Trump has claimed, they're paid by Americans. When Walmart announced it would be raising prices due to these tariffs, Trump responded not with policy clarity but with a tweet storm, telling the company to eat the tariffs instead of passing the burden to consumers. But in the real world, economics trumps bravado. Here's why. Trump's administration imposed tariffs on hundreds of billions of dollars worth of Chinese imports, claiming it would punish China and benefit American workers. But tariffs don't work like that. They increase the cost of imported goods, costs that are paid by importers, passed to wholesalers, and ultimately absorbed by consumers. For example, if a Chinese-made microwave cost Walmart $100 pre-tariff, and a 25% tariff is imposed, the cost becomes $125. Walmart's business model relies on low margins and high volume, so absorbing the tariff would mean sacrificing profits. Instead, they raise the retail price to maintain profitability. Multiply this effect across thousands of products and you get widespread price hikes in everyday goods, from electronics and clothing to toys and groceries. Walmart is not in the business of price gouging. In fact, its success is built on offering the lowest prices possible. For a company whose primary advantage is undercutting competitors, raising prices is a last resort, taken only when the alternative is losing money. Trump's suggestion that Walmart should simply eat the tariffs reveals a fundamental misunderstanding of how businesses operate. If Walmart absorbed these costs without adjusting prices, it would erode their already thin profit margins, potentially pushing them into losses. That's not a sustainable ask for any company, let alone one with shareholders, employees, and customers depending on it. Shortly after Walmart's announcement, Moody's, a respected credit rating agency, downgraded the U.S. credit rating outlook. The reasoning? Mounting debt and the permanent extension of Trump's 2017 tax cuts, which could add trillions to the deficit. According to the New York Times, the bill in Congress aimed to solidify those tax cuts permanently, without offsetting revenue. This could push U.S. debt past unsustainable levels, raising borrowing costs and rattling investor confidence. When a credit rating agency downgrades U.S. debt, Treasury bonds become riskier. Riskier bonds require higher yields or interest rates to attract buyers. That means higher borrowing costs for the federal government and potentially higher interest rates for everything from mortgages to student loans. Trump may have been able to pressure political allies and command media attention, but markets respond to fundamentals, not bluster. Investors are already signaling their discomfort. Stock market volatility has risen, and Treasury yields have climbed in response to credit concerns. Federal Reserve officials speaking on CNBC warned that the downgrade would affect the cost of capital and have ripple effects throughout the economy. In other words, uncertainty created by political decisions, especially unbacked tax cuts and aggressive tariff regimes, shakes confidence in the U.S. as a safe economic bet. Trump's supporters may appreciate his combative stance toward China, but the data tells a different story. A 2019 study by economists at the Federal Reserve Bank of New York, Princeton, and Columbia found that the full burden of tariffs was falling on U.S. businesses and consumers. The average U.S. household was estimated to be paying an additional $831 annually due to tariffs by the end of 2019. With renewed and expanded tariffs under consideration, that figure could rise significantly. Perhaps the most troubling aspect of Trump's behavior is the precedent it sets. Telling private companies what they should charge sounds more like command economics than free market capitalism. As Senator Claire McCaskill put it, this kind of interference mirrors the tactics used by socialist and communist regimes, governments that dictate prices and penalize companies for adjusting to market forces. If a Democratic president were to tell Amazon or Apple what to charge for goods, Republicans would be screaming about government overreach. Yet Trump's directive to Walmart went largely unchallenged by his allies in Congress. At the end of the day, numbers don't lie. Tariffs are taxes, debt adds up, and markets, unlike political rallies, don't respond to insults or tweets. Walmart's price hike isn't a political attack, it's a reflection of cold, hard math. As consumers face higher costs, investors hedge against instability, and America's creditworthiness slips, it's becoming clear you can't bully the market. And when the bill for economic mismanagement comes due, it's not China footing it, it's the American public. What to watch? Will other retailers follow Walmart and announce price hikes? Could another credit rating agency follow Moody's lead? How will voters respond when tariff-driven price increases hit their wallets? The answer may determine not just the next election, but the future stability of the American economy. Thanks for watching.